To our talk of the tape, with an already strong bull market getting an extra kick from anticipated policy help and the Fed loosening policy into a sturdy economy, what's not to like? Let's ask Cameron Dawson, NewEdge Wealth Chief Investment Officer. It's great to see you.
Good to see you.
You know, it's sort of, you line it all up like that, it looks like green lights as far as you can see. Is there anything to bring into the conversation to complicate the story?
I do think we have to respect the uptrend, which has been just so very powerful this year. And clearly through the election, we removed the tail risk of potentially higher corporate taxes and maybe higher regulation, which is certainly something that the market is celebrating. We cannot ignore that valuations are very stretched. We're at 22.5 times earnings. We also cannot ignore that earnings estimates themselves have actually been getting trimmed over the last couple of months. And so you're seeing this divergence brew where the upside in the market really driven by sentiment, driven by valuation, not necessarily because of a fundamental change in the earnings picture. So we think we have to watch that the most closely over the course of the next couple of months.
Yeah, I mean, the valuation has been certainly a little bit of a shadow on the market for a while, more so now. 22.5 times, as you mentioned, it's pretty much as high as it's been since the post-pandemic boom, when earnings were probably a little more depressed. And you mentioned, 275 is where S&P earnings for next year have been cut back to a little bit. So whatever you say, it's still 21 times next year's number. I guess you would counter that by saying in a bull market, if the stories line up, and right now you have this ability to believe that either the cycle can sustain itself for longer than we expected, or it can accelerate to a degree in a private sector friendly way. I mean, I think that seems to be the chatter.
And I do think that valuations at the end of the day need a catalyst in order to be able to be a true weight on the market. And what you typically see is that valuations start to fall when you're cutting growth estimates, when you're cutting EPS estimates, when people are getting more concerned about the outlook. So even though we're now pushing up against those 2020 highs, and to your point, those were 2020 highs based on depressed earnings and the Fed that was growing money supply at 30%. You were flooding markets with liquidity. Very different story. But until you start getting a question about growth, then we do think that valuations keep potentially drifting higher. It's why valuations are a poor timing tool. Really helpful for the 5-year, not at all helpful for 1 year.
In terms of timing, or at least tactical considerations right now, you can't really stand in the way of that kind of momentum move we saw a couple of days ago. Usually that tells you, again, as you say, the trend is pretty sturdy. But what about, expectations for whether we need to cool off a little bit?
Well, we are overbought if we look at things something simple as the RSI. So it is expected or would not be too much of a surprise to see a little bit of a digestion. But to your point, you did see that breadth surge. You saw the number of 20-day highs surge to 55%. You had folks like Jeff DeGraff saying that you've effectively gotten escape velocity. These are things that you typically do not see at market tops. It does not mean that you can't digest the power of the move, mostly if we have something like a CPI that comes in a little bit hot next week, which could jostle markets, for example. So, of course, we have to keep those things in mind, but usually the track record of breadth surges is positive.
It is. It's certainly eventually positive. Almost everything, when you dial it ahead 12 months or so, it usually resolves to the up.